We're going to start with Ingrid. Just how did the overall market cope with all these reports out today?
Well, it was quite a negative day for markets at the start of the session. Ending the session, though, just down 0.2%. Some of those results did help drag it down. But the silver lining is it's off the lows of the day as the miners in the energy space have risen. Now, it comes as iron ore prices more broadly have spiked, heading for the best close in almost a year, actually, thanks to hopes around the China recovery.
Rightio. Well, BHP is Australia's biggest company and the world's biggest mining company. The last financial year, well, it was stellar for BHP. But look, Ed, the interim result this time around, it's probably disappointed in terms of those dividends and the profit as well.
Yep, Ross. Look, profit, revenue and dividend all down for BHP. Iron ore prices were 25% lower in the half, while copper prices were down 19%. BHP still fetched about $85 a tonne for its iron ore, which cost them just $15.50 to produce. BHP also announced it would sell 2 Queensland coal mines as it shifts to commodities like copper and potash. BHP is expecting increased demand for its resources from China and India, which will help it offset a slowdown in demand from the US, Japan and Europe.
All right, so there is the BHP results. Let's get the market reaction. Ingrid?
OK, well, looking at BHP shares today, of course, we did see them close down about 0.3%, but it did stage somewhat of a comeback in today's session. It was down about 2% at the start of the session after its weak across-the-board results, but has managed to claw back, as I said, most of those losses today.
OK, so I spoke with BHP's Chief Executive, Mike Henry, just a little earlier and asked him if higher inflation could cause a washout in the mining industry, especially if other miners find their profit margins being squeezed.
Look, it could play through in different ways, Ross, and it's probably going to be a little bit of both. So one will be, yes, in a world of high inflation, some suppliers will get priced or costed out of the market because their costs will rise by too much. But the other thing that it can do is give rise to higher commodity prices. And if you're a low-cost producer like BHP is with a lot of operating discipline, large assets at the low end of the cost curve, that can actually help to improve margins over time, as those at the high end of the cost curve require more to stay in the market. So, it's that sort of thinking that has underpinned the strategy that we've had to ensure that we've got large assets in deliberately chosen commodities at the low end of the cost curve, and then to operate those assets really, really well. Because the single biggest value growth lever for BHP does lie in productivity. Given our scale, small increments of productivity create a lot of value for shareholders, and so that's focus number one.
And that full interview on Business Weekend. We did explain earlier the change or the impending change in Chief Executive at Coles. Ed, look at the results. This is really all about grocery inflation and consumer demand, isn't it?
It sure is, Ross. Look, Coles said price inflation was 7.4% during the half year, driven higher by the dairy sector, fruit and vegetables and higher supply input costs. But the good news is Coles said these cost pressures are starting to ease in the new year. Tomatoes, capsicums and broccoli are in deflation. So it lifted profit, revenue and dividend. And it says inflation is expected to continue moderating this year and this half. And Ingrid, how'd the shares go?
Yeah, that uncertainty around the timing of the transition in CEOs that Ross mentioned a little earlier has investors a little off today. So the shares did fall around 1% at the end of the session.
OK, so let's go from supermarkets to one of their biggest suppliers. Australia's largest fruit and veggie grower is Costa Group. This company does my head in every single time there's either weather happens here or something is a profit warning there. What did they do this time?
It was weather again, Ross. So it's very dependent on the weather, and when there's been too much rain, it suffers, and that's what happened
when there's
in
too
the
little,
calendar
it
year.
suffers as well.
Earnings from citrus crops $40 million lower than expected. Costa Group is expecting a return to normal growing conditions this year and better years ahead as La Nina finally goes away. And Ingrid, what was the share reaction?
Well, this one can swing quite wildly in reporting season, but it didn't swing by too much today, down by about 1.1% after those earnings missed expectations, mainly due to that weakness, as you say, in domestic produce, and that is even despite the dividend being a little better than expected. OK,
so and let's stick with the retail theme. One of Australia's biggest shopping centre companies is Stockland, also a developer of residential communities. So this is about shopping and housing, Ed.
Absolutely, Ross. The retail business for Stockland did well, with consumers still spending money, but property sales slumped due to uncertainty around rising interest rates. Stockland's profit, revenue and dividend were down during the half. It's expecting property sales to slowly start to pick up again once the interest rate market stabilises. And Ingrid, what did investors think?
Yeah, not a good day for Stockland. Although it did retain its guidance, it did warn of that uncertainty ahead, and investors are not convinced of the outlook one bit, 3.3% weaker for Stockland.